Hello guys, and welcome to this presentation. Today I'm going to be presenting about institutional order flow trading. This tutorial is based on institutional order flow trading basics. Right. From my understanding of the market, the market does not move randomly. It doesn't move in a haphazard way. The market moves are calculated. There is a system that they follow. It's not just a random act. Price movement is controlled. Yes, we do get fundamentals that affect price. But by the time fundamentals affect price, certain moves would have already been instigated into the market. So fundamentals are just there to fulfill the technical side of price movement. What is institutional order flow? There is a lot of traders out there. We've got retail traders, institutional traders, market makers. Institutional traders, we can basically call them also market makers. But for me, they're all one and the same thing. So basically we've got institutional traders and we've got retail traders, which is us, the small boys. Institutional traders are the big boys. These are the big guys at big institutions who trade large sums of money. As retail traders, our equities is not that big compared to institutional traders. So that's what we are going to be talking about today. I'm going to be teaching you or showing you how you can utilize institutional order flow to your advantage, how you can use it in your day-to-day trading. Okay, so let's begin. So for the disclaimer, any opinions, news, research analysis, prices, or other information contained in this presentation are provided as general market commentary and do not constitute investment advice. BullishFX Consultancy is not liable for any loss or damage, including without limitation any loss of profit which may arise directly or indirectly from use of or reliance on such information. BullishFX Consultancy has taken reasonable measures to ensure the accuracy of the information in this tutorial. Trading commodity futures, options, CFDs, spread betting, and foreign exchange, which is the forex market, involves a high risk and can cause you a complete loss of your funds. So guys, please be aware of this disclaimer. I'm not a financial advisor. So you need to understand that you can lose all or part of your investment. Right. So what to expect in this presentation? We're going to look at some general remarks. We are going to look at challenges which institutional traders face. We are going to look at liquidity pools, or in other words, we can call them areas of interest. We're going to talk about stop hunting. Then I'm going to show you a few chart examples, and then we've got the summary to wrap up the presentation. Right. When we talk of institutional order flow trading, what really are we talking about? Right. So when we are trading using this strategy, I'm gonna call it a strategy, but it's more of like you are trading hand in hand with the big guys, with an institutional trader. You are trading together with him. You are not trading opposite. Yes, you can trade opposite, but the likely chances are you end up losing if you do that. So what I have realized ever since I started doing trading in 2013, yes, we all know that most retail traders, they don't make money. Most of retail traders, they always lose money, and this is probably one of the main cause why retail traders lose money. They don't know like what concept are used in the market. So we are going to look at what factors move the price, where does it move to, and for what reason. When you look at the price on a chart, AUD USD, what moves it, you see, and where does it move to, and why is it moving to that area? Okay, before I go any further, guys, this presentation is not for beginners. It's for those guys who have been in the industry for a while, those who understand the market. If you are a beginner, I would advise you to look at my other course for beginners. This one is more advanced concept of trading. So you basically need to know exactly what you are doing for you to use this kind of trading strategy. Okay, let's carry on. We are going to look at high probability setups from higher time frames. You see, these setups, they offer us low risks. We are going to be looking and analyzing charts in a whole different way. The moment you start following an institutional trader, or the moment you start understanding how an institutional trader do, then the charts are gonna look a whole different from what you know right now. It will be a whole different scenario altogether. Most institutions, they base their trades from a higher time frame. When you're trading a large account, when you're an institutional trader, it's not always you see institutional traders hunting for setups on lower time frames, like 5 minutes, 15 minutes. They don't base their trades on those time frames. They base their trades on a higher time frame. By doing so, they aim to buy at cheap price and selling to a retail price. This is basically a smart money concept. So once you have understood institutional order flow, trading is gonna start to make sense. You are going to see a lot of things that you were not seeing from what you were doing before. Yes, there are some who are using it out there. I'm sure they will agree with me that institutional order flow makes more sense. Yes, we can hunt setups on lower time frames. We can scalp the markets 1 minute, 5-minute chart, but that is not sustainable, guys. You can't sustain that over a long period of time, because you are going to be looking at the chart all the time. Imagine you enter a trade on a 5 minute. It means you'll be stuck on the chart all the time, monitoring that trade. But if you enter a trade, say on a higher time frame, on a daily time frame, on a 4-hourly time frame, on a weekly time frame, you have the time to breathe. You see, you let the market do what it's doing without worrying that your trade is gonna go other way. On a 5-minute time frame, clearly you won't see which direction the market is taking. Yes, it can be a huge bullish or a huge bearish movement, but that's not the real picture of the market. Okay, so what is an institutional trader? Okay, this is a person trading for a firm or huge hedge funds and banks. These are guys who trade large equity accounts. We are talking of massive accounts here, not small accounts. And a retail trader is the opposite. He's a person trading his or her own personal account, mostly smaller accounts. Right. Now let's look at what challenges do they face. What are the challenges for institutional traders? The main challenge that they face is, how do they engineer liquidity? That is the main challenge that they face. And when I talk about liquidity, it's the basics. For every seller, there has to be a buyer. Same applies for every buyer, there has to be a seller. Someone else has to fill your order from the opposite direction, guys. The moment you enter a trade, say a buy trade, someone is going to be selling to you from the opposite direction. So for institutional traders, they can't just go smash, bang into the market. It's going to be difficult for them to do that, you see, because the feel is going to kill them, the spread is going to kill them. So they need to engineer liquidity for them to get into the market. Remember, these guys are entering the market with huge sums of money. They're entering the market with huge lot sizes, right? So how do they then create liquidity? How do they create liquidity for their short positions or for their long positions? Right. So for an institutional trader, if he wants to go long or to enter the market with a long position, they are going to require short liquidity. For a sell or a short position, they are going to require long liquidity. So from an institutional point of view, what does that mean? For them to trade long, they require shorts. That means sellers. For them to trade short, they are going to require long. That means buys. So how then do they get around this challenge? Right? How do they create shorts when they want to trade long? Engineering long liquidity, and how do they create long when they want to trade short, which is engineering short liquidity. So let's look at liquidity pools. So liquidity pools, or you can call them areas of interest, these are areas where there is likely to be a lot of stops or limit orders. Limit orders can either be buy or sell, right? A limit order is defined as raw liquidity which is triggered by a price rally through a certain area. From an institutional point of view, if price rallies through price X, sell orders will be triggered. And when sell orders are triggered, that's long liquidity. That's from an institutional point of view, guys. Take note. If price rally through X, buy orders will be triggered, thereby creating short liquidity. From an institutional point of view, if price rallies through a certain area, buy orders will be triggered, thereby creating short liquidity. Then, how do we identify liquidity pools? How do we know that this area is a target? You already know these guys, but it's just that most people, they don't take note of. We all know where most of us retail traders put our stops. The following areas are most likely to be the source of liquidity: below range highs, above range highs, below swing lows, and above swing highs. These four categories are the main areas where institutional traders will be hunting for liquidity. These are the areas where they hunt for liquidity. We all have been through this, guys, when we were starting amateur traders. Where do we put our stop loss? 10 pips, 20 pips above a swing high, 10 pips below a swing low. You see, 5 pips above range highs, 5 pips below range lows. You see, so these are the areas where big guys are gonna be targeting for their liquidity. It's basic, guys. Have you ever entered a trade? The moment you enter a trade, say the market is bullish, right? And you anticipate the market to keep, for example, say the market is bullish on a weekly time frame, right? But say on Tuesday or Wednesday, you get a huge bearish move. Then you'll be like, the market is tumbling down, guys. Support and resistance, I'm entering the market. It has broken down, I'm entering the market. We all have entered trades like that. The moment you enter the market, it swings right in the opposite direction. It takes out your stops and then it runs away from your entry. We have all been through that. Right. So, what are the common mistakes that most traders do? Most traders assume that above every high or below every low there is liquidity. This is not correct. It's wrong to assume this, guys. It's totally wrong. Try focusing on the following to filter out probable liquidity areas. This is what we need to do to identify probable liquidity areas. Most likely areas where retail traders put their stops. Remember the 4 categories that I've mentioned previously. Higher time frame highs and lows, most notably on D1, weekly and monthly charts. Those so outstanding highs and lows. Those are probable liquidity areas also. And we've got extended consolidation ranges. What do I mean by this? Normally when market ranges for a long time, there's going to be traders waiting for breakout on both sides. So these traders, what they do is they'll set their buys and their sell limit orders. You see, buy and sell limit orders will be resting on both sides for those who are anticipating to enter the breakout of the range. That's another area for liquidity area. Swing points, notably on high time frame, work much better because almost every trader will recognize them. It's like we all look at daily charts, then we see that price is approaching a very strong area of resistance or support. Everyone is going to notice that. This in turn means a lot of orders are placed below or above them. I personally use swing points on weekly, daily and 4-hour time frame to define my probable liquidity areas. We also have equal highs and lows. These are also probable liquidity areas. So now let's look at stop hunting. By now most of us know how to identify liquidity area and also what is the purpose for liquidity. Let's look at stop hunting. Stop hunting, this is when price trades through an area where most retail traders assign their stops before rallying in the opposite direction. So then how do we define stops? So let's look at a bearish example first. What is a stop in a bearish market? This is when market takes out a high or breaks resistance before rallying lower. This would then create buyers, and when buyers are created, that's short liquidity. Do you understand this? When market takes out a high or breaks resistance before rallying lower, this will then create buyers, and when buyers are created, that's short liquidity. Okay, what I'm describing here is market is bearish, right? When market is bearish on a higher time frame, say you jump onto a 15-minute chart and then you see market is rallying crazy, going up. It rallies crazy going up, and then it takes out what? Probably previous highs. The moment it does that, it takes out previous highs, we are going to anticipate that market is going what? Higher. When in actual fact, it's just enticing us to get into our buy positions. You see, remember the sentiment of the market is bearish. So when we've all get into the market with our buy positions, the market will roll downwards. Same applies with the bullish scenario. Stop losses of those who are short. When price rally through this, they turn into market orders to buy. Remember that stop loss that you would have set. The moment market takes out that stop, it means someone has bought out that stop. Someone bought from that price where you put your stops. Limit orders of those who are anticipating to go long. when price rally through these, they turn into market orders to buy. So what's achieved? Buy orders, which are basically longs, will flood the market. You see? And when longs flood the market, they are in turn creating short liquidity. You understand, right, what I'm trying to say here, guys? When longs flood the market, they in turn create short liquidity. And when this happens now, institutional traders, they have the opportunity now to pair their shorts with the retail buys and then take the market tumbling down. That's when you see most times, let's say you enter a buy position and you're so confident that no, this thing is gonna go up now. But the moment you enter into that market, 15-30 minutes into the trade, market takes you out and then it runs the opposite direction. The relationship between stop hunting and liquidity pools should be clear to you now. Most traders' stops are the ones that create the liquidity. They all tend to be concentrated in certain areas, which we have covered before. We need to think like institutional traders, guys, if we are to hop on the same bus with them. We need to define where to get the liquidity. The moment we can be able to do all this, it means our trades will be running concurrently with the big guys' trades. That in turn will help us being profitable. When we want to trade short, we need to define or locate where price needs to go to create buyers, to trigger buy stops. Because buyers in turn will create short liquidity. When we want to trade long, we need to define or locate where price needs to go to create sellers or to trigger sell stops, because sellers in turn will create long liquidity. So it's like doing the opposite. You see what the market is doing, analyze it from a higher time frame going downwards, and try to do the other way around. Most times, this is the reason why market price will take out a high before tumbling down in the opposite direction, or it takes out a low before rocketing upwards. Everyone has seen this before, but we didn't know. You go into the market, a very good setup will be in front of your eyes. You get in, market runs away from you. Like rapidly, it runs away from you. You'll be like, whoa, this thing, I just got in, and then it goes the opposite way. That's what happens, you see. It's the big guys taking you out of the trade. So how to differentiate a real breakout and a stop hunt? Well, basically this is very difficult. That is why most times stop hunting works well against retail traders. But there are certain criteria that we can apply to avoid getting caught up in a stop hunt. Take note of what price is doing. Monitor the price action, guys. Don't ignore price action. If a price rally is a stop hunt, price normally reacts when highs or lows are taken out. Wicks which are tall are also a good example of a stop hunt. Absence of momentum is also a good example of a stop hunt. Try to avoid putting your stops, these are limit orders or stop losses, at areas which are obvious liquidity target areas, guys. Try to avoid putting your stops in those areas. Remember the one I mentioned before? Swing highs, swing lows, range highs, and range lows. Try to avoid those areas. If you see yourself after analyzing a pair, when you are ready to enter the trade, if you see yourself, ask yourself, where is my stop loss in relation to price action? Then study the price action. Divergence do also help, but take note which divergence it is. Bearish divergence or bullish divergence, hidden bullish or hidden bearish. I've got also another course that touches up on divergence in the deeper form, so you can check out my course section for divergence course. Now let's take a look at a few chart examples of what we've been discussing. Right, looking at this chart, guys, you can clearly see that what I've been talking about for the past 30 minutes is exactly illustrated in this chart, right? This chart is a screenshot from the 6th of August. If you look at this chart, it's a 15-minute chart. What was really happening here is you see this low here to this high. This is a massive swing on a 15-minute time frame. Look how price moved away from this level here. It moved rapidly. It violently moved from this level, then it created this swing high, and then it came down. You see, when it came down, take notice of this. It takes out the previous low, and you see it took out this previous low, but what happened? It closed above. Basically what I've taught you guys, taking out a low in a bearish market, then rally up. The moment it took out this low, imagine how many people had their sell orders there that have been taken out. They got triggered, then it rallied up against them. Because the moment it broke here, most people would have anticipated a breakout. But remember, this is just a 15-minute time frame, guys. It's a 15-minute time frame where we mostly define our entries into the market. So it took out the previous low. The moment it took out that previous low, that was engineering long liquidity. Sell stops were triggered from here. People who bought, they put their stop losses long down here. They also got taken out. Then market rallies in the opposite direction. For your homework, I want you to look at this low here, and then you must tell me what happened after that. And I'm gonna tell you exactly, this market rallied up. It took out the low, it rallied up. It took out this low, took out this low, took out these ones here, and rallied way up. So this was long liquidity being engineered. You see, a lot of people, they cried from this swing low here. A lot of people got taken out of the market. Sell orders were triggered. You see, people were anticipating the market to keep tumbling down. Their sell orders were triggered. Next example, this is Euro AUD on an H1 time frame. Look at this swing here. So from this point, swing higher to this swing low. This is a massive swing in the market. Remember, it's a 1 hour. So what we do now, we take note of this high here. Now look what happens when the market retested that high. Look what happens. It broke it, kept on going up, but it closed way down. Even the two previous swing highs, it closed below that. This was short liquidity being engineered. Stop losses being taken out. You see? Buy stops, buy orders being triggered, then market tumbled down. They do it twice. Here, this swing high, swing low, takes it out, tumbles down. You see, guys? So the moment we start noticing that, yeah, it might, to many people, it's going to be like basic support and resistance, but it's different. Look at the way price moves away from the swing points. Look how price moves away from here. Violently, it runs away. Swing low, violently, it runs away from the swing low. You see? Look here. This swing high here, the one that takes out the previous high. Market goes up, closes below, and runs away. You see? That's a huge footprint in the market. It tells you that someone big has entered the market. Support and resistance, you can have a range. You can also have a range. But it's very rare that you get these violent moves from a support area or from a resistant area. It's very rare. Market will meander around before going either in the other direction. Look how it moves away from this swing high here violently. And remember, this is a 1 hour chart. Imagine you jump down to a 15-minute. That's a huge move on a 15-minute time frame. Okay, let's look at the last example. This is gold on a daily time frame. You see what I was talking about, guys? Huge, higher time frame. They offer more in terms of return. Right, we've got this swing low here from this swing high. See here, this is a huge swing in the market. Remember, it's a daily. This swing high, this swing low. We've got another swing here to this swing low. Now take note of this. This here. Market came down to this low here. See how price moved from this low? It moves fast, very fast away from it. Then it went up. Look what happens when it came down. It takes it out. But on this example now, it didn't close above. Can you see? It didn't close above. But the same principle should apply to you. You should know these basics. The moment you see this swing being taken out, you jump down to a lower time frame, whether it's a 4 hour or a 1 chart. You start hunting for bullish patterns there for the market to go the opposite direction. You see? Of course, we are now looking at the market in hindsight, things that have happened before. But say market closed here and we don't have this other information to our right. Personally, I'll be hunting for bullish patterns from here onwards. You see? I'll be hunting for bullish patterns. So this was long liquidity being engineered. And then look what happened. Market runs away. It created another swing high. When it created another swing high, what happens when market came back to that swing high? Takes it out, close below. Short liquidity has been engineered. From here onwards, you're looking for what? Bearish patterns for market to go down. It's simple, guys. Very simple. This is a daily time frame. You see a swing high being taken out, and then market closed below. What do you do the next day? You jump into lower time frame. You look for bearish patterns to go lower. You get my point? It's very easy, guys. It's very easy to trade, but we need to know exactly what we are doing. Let's trade together with the big guys. Beating the market maker, that thing does not exist. It's just a term which someone created. We can never beat those guys. So what do you do if you can't beat someone? You join them. Join the bandwagon. Trade in line with them. It's very simple. Market takes out a swing low, close above. Next day, what do? You look for bullish patterns. Market continuation, it goes up. You see, these are trades that you need to look at. Trades from a higher time frame, which offers low risk but high returns. You see? See here. This swing high here. It took out this swing high. See how price moved from here. It moved violently. Then the moment it came back, takes it out, closed below. Look on the next day. The next day, it was all bearish. You see? The market was bearish. And then it tried to retest again that swing high, but it couldn't. Then look what happened. Market tumbled down. So from onwards, you'll be just looking at bearish patterns for you to enter the market on a lower time frame. You see, you'll be anticipating bearish movements. If you look from this swing high here to here, the huge moves are happening going where? If you look at it, they are happening going downwards because market is bearish after taking out this swing high. If you look from here, when they engineered this long liquidity here, huge moves happening going where? Higher. You see? So it's very simple. You see market close above after taking out a swing here, after taking out this low here, then market closed above. Next day, what you do? Of course, you look for bullish patterns. You see, you look for bullish momentum on a lower time frame because it all looks a whole different on a lower time frame, guys. Remember, this is a daily, but if you jump to say a 15-minute, you see market tumbling down. Then you'll be like, what's happening here? But that will be the sign, guys, for you to get into the market. You see, it's not that difficult, this strategy of order flow trading. It's not even difficult. I hope you do understand what I'm saying here. Okay, so to wrap it up, I don't want to take much of your time already. We've got 40 minutes on the clock now. Institutional traders, they can't just smash the market with their orders. They need to create the liquidity for their orders. So how do they do that? How do they create sellers? That's liquidity for going long. They take out a low and break support, paint a picture that price is in a strong bearish momentum, then boom, they go the other way around. They skyrocket. How do they create buyers? That's liquidity for going short. They take out a high and break resistance and paint a picture that price is about to skyrocket. Before you know it, boom, price is going down very fast. You won't even catch up. If you try to chase it, the spread is gonna kill you. You see, that is exactly what happens. You see, liquidity pools, these are areas where most retail traders place their stops. These are stop losses and limit orders. A stop hand, this is when a retail stops gets taken out to create liquidity, i.e. that's price would dip into a liquidity pool and rallies the opposite direction. You see? So you need to take note of this. Take note of price action. What is price doing? Don't just guess the market is gonna go up. Oh no, the market, this average, moving average is telling me this. No, guys. It doesn't work like that. And also take note that every swing high or swing low is a liquidity pool. No, that's not it. I would advise people to stick to higher time frame swings, T1, weekly and monthly swings. If you stick to these time frames, then you can plan your trades from there. You see, look at the previous example I showed you. You see, this is a daily time frame, right? The moment you see this low being taken out here, you see, you are in the market. You start hunting for bullish movements, bullish patterns. You jump onto a lower time frame, H4, H1, good time frame for entries. You start hunting. You see the wicks on these things. These will be all your entries to go long. All your entries to go long. You see? It's very easy, guys. Very, very easy. This is basic. Long liquidity was getting engineered here and here. Short liquidity getting engineered here and here. And you jump to a lower time frame after the high has been taken out. You look for bearish patterns. Then market is gonna tumble. This happens every day, guys. So take note that not every swing high or swing low is a liquidity pool. Not every swing high on a 15-minute is a liquidity pool. You see, not every swing low on a 30-minute is a liquidity pool. So please, guys, stick to D1 and weekly 1 higher time frames for your trades. When you're entering the market, start from a higher time frame perspective, and then you jump to a lower time frame to hunt for continuation patterns, you know, bearish continuation, bullish continuation patterns, breakout patterns, so that way you minimize your risks. You see, you minimize your risk in that sense. So basically, guys, this is what I've just wanted to share with you in terms of institutional order flow. I'm going to continue from next week. We are going to be taking a deeper look into trading order blocks, weekly order blocks, bearish order blocks on a weekly time frame, bullish order blocks on a weekly time frame. So for those of you who would like more of this, just subscribe to my channel or get in touch with me at info@BullishFXConsultancy.com. I hope you all learned something today. Have a good trading week, guys. Thank you.